Hi, my name is Paul, and welcome to month number 6 of my $100 per month Canadian stock portfolio series. In this episode, I'll be covering Knight Therapeutics' first quarter earnings report, and I'll also be talking a bit more about stocks that I'm considering adding to the portfolio. I've also made a few additions and changes to how I'll be tracking the portfolio's performance. In addition to that, I will of course be showing how the portfolio performed over the last month compared to the benchmark ETFs. And as always, I'll be showing you how I'll be investing this month's $100 of capital contribution and the dividends earned over the last month. And just like last time, I'm going to be skipping over the goals and rules since they've already been outlined clearly in the earlier episodes. But if you do want to see the goals that I have for the series and the rules that I've set out for this portfolio, then there's a document linked in the description of this video that has all of that information in detail. With that said, let's quickly go over a brief recap of the companies that I hold within the portfolio. The largest holding is the Morguard North American Residential REIT, ticker symbol MRG on the Toronto Stock Exchange. Now, there are two other Morguards on the TSX, so make sure that you're looking at the right one. Again, it has the ticker symbol MRG. Morguard owns and rents out apartment units in cities and large suburbs throughout the US and Canada. The reason that I've been investing into Morguard is because I believe it is heavily discounted when comparing it to its peers. Also, the company operates an easy-to-understand business that I believe will continue to grow returns for a very, very long time into the future without much risk. Last month, I invested around $72 of the $100 of monthly contribution into Morguard because it's currently my strongest conviction in the market. The next holding in the portfolio is Knight Therapeutics, which trades under the ticker symbol GUD on the Toronto Stock Exchange. Knight is a specialized pharmaceutical company that predominantly operates in Latin America through the licensing, marketing, and distribution of pharmaceutical drugs. The decision to invest in Knight Therapeutics is centered around a special situation involving a historically successful management team that specializes in acquiring undervalued pharmaceutical drugs and growing them much larger. I believe that Knight Therapeutics is a deceptively hard to understand company that carries with it an outsized reward for a relatively low risk. And I see a lot of this upside coming from Knight's loans to biopharmaceutical companies that allow Knight the exclusive rights to commercialize successful products developed by the borrowers. Now, last month I spent about $5.33 out of the $100 purchasing only one share of Knight Therapeutics. The third and final security that I hold in the portfolio is MTY Food Group with the ticker symbol MTY, also trading on the Toronto Stock Exchange. MTY operates and franchises fast food, casual dining, and other specialty restaurants internationally, though most of their operations are centered in the US and Canada. MTY also sells and distributes retail food products, which is a very fast-growing revenue stream for the company. Like Knight Therapeutics, MTY Food Group has a history of strong success in acquisitions thanks largely to founder-led guidance and strict cash flow-focused strategies. These acquisitions have propelled the company into becoming the best long-term EPS growth compounder of its peers. And despite the amazing capital returns to the business, MTY continues to trade at a discount to its competition. This is why last month, I decided to increase my holding in the company by allocating $23.41 of the monthly contribution into MTY Food Group. And that concludes the summary of business operations of companies held within the portfolio. If you want a more detailed account of my reasoning behind these investments, then I'd recommend you go back and watch the first 2 episodes of this series. You can find these videos within the monthly portfolio playlist, which contains every single episode in the series in order. And you can find a link to that playlist in the description of this video. Now, let's take a look at the important news that came out over the past month or so. First, I'm going to go over the Morguard North American Residential REIT, which only really announced that the dividend will be paid on June 15th, in the same amount as the prior month. Next up is MTY Food Group, who, despite not receiving any noteworthy reporting in the month, did release 9 new retail products since I created my MTY retail product video on the subject just a couple weeks ago. And I think it's also noteworthy that 2 of these new products that were added are coming from a new MTY retail product banner, that being Turtle Jack's Muskoka Grill. But that's about all for MTY. Now let's go over Knight Therapeutics' first quarter webcast and results. And it was almost all good news. Starting with the revenues for the company, the numbers were up across all segments of Knight's portfolio, and most of this was explained by an increase in patients seeking treatment as COVID restrictions are lightening, the revenues generated from the acquisition of Exelon, which was acquired after Q1 of 2021, and the growth of Knight's branded pharmaceutical products. The gross margin for the quarter was also up, hitting 51% versus 45% in the first quarter of the previous year. Excluding the impacts of hyperinflation, the gross margin would have hit 53%, and this is mostly due to Exelon, which again wasn't acquired in the previous period. Now, Knight did again report a net loss for the quarter of $18.8 million, which is reasonable considering the ongoing hyperinflation within countries where Knight operates. And this came on top of supply chain issues related to the COVID and Russia-Ukraine conflict. That said, I wasn't particularly happy that this didn't receive a note explaining what materially impacted earnings in the management discussion and analysis, especially when considering that the $16.6 million net loss on financial assets was explained. And this loss came almost entirely from the unrealized losses on publicly traded equities that Knight holds within its strategic investment fund. This means that Knight still owns most of these other publicly traded shares, but now they're worth a little bit less than they were last quarter, which shouldn't be a surprise considering the recent market correction that's been taking place over the past few months. That said, the net losses aren't too big of an issue, since free cash flows came in at a positive $12.8 million for the quarter, thanks in large part to the incredibly low levels of capital expenditure required to continue running operations. Also, if the current levels of free cash flow can be maintained, then the company is currently trading for a price to free cash flow of around 12. Also, this inflow of free cash flow at relatively low levels has allowed for the repurchase of $9.1 million in shares throughout the quarter, for an average price per share of $5.29. Subsequent to the quarter's end, Knight has already repurchased an additional $4.7 million worth of shares for an average share price of $5.33, which is very nice to see. On top of this, the company did raise top-end guidance, now expecting between $260 and $270 million in revenue for 2022, where before the high-end projection was $265 million. This is a good sign, but management did note that the top line could be a bit lumpy, with some concerns surrounding the uncertainty of future COVID-related impacts, as well as increased costs of doing business and potential delays in the ongoing process of transferring market authorization of Exelon to Knight. In both the webcast and the quarterly report, Knight updated investors on the GBT acquisition, announcing that they've recently been successfully restructuring the executive and senior management teams and are implementing a new, better optimized management system with a specific focus on integrating an enterprise resource planning software that is expected to be fully operational by the end of 2022. The latter part of this was known beforehand, but the scale of the changes to management in order to establish a model better optimized for profits was an unexpected but welcome surprise. Speaking of welcome surprises, Knight also announced 2 new partnership deals. The first deal was with a company called Helsinn, in which Knight acquired the rights to exclusively license, distribute, and supply Akynzeo in Canada, Brazil, Argentina, Uruguay, and Paraguay, and the drug Aloxi, but for Canada only. This also came with a note stating that the combined sales of Akynzeo in Brazil and Canada alone totaled $7 million in 2021. Both Akynzeo and Aloxi are antiemetics that are used to prevent nausea and vomiting caused by chemotherapy. Unfortunately, financial details on the terms of the deal haven't been provided as of yet, but we should get more clarity in the next quarter. The second deal was with the company Rigel Pharmaceuticals, who granted Knight the rights to exclusively commercialize the drug fostamatinib in Latin America. Fostamatinib is used to treat chronic immune thrombocytopenia, which, as I understand it, is when the body produces antibodies that attack their own blood platelets, oftentimes leading to excessive bleeding and bruising. Now, this deal did come with a bit more detail in that Rigel was paid up front and will receive bonuses centered around regulatory and commercial milestones, as well as royalties that are dependent on the drug's net sales performance going forward. That said, the specifics of the deal were not outlined in the announcement or the conference call, though I expect we'll learn more in the next quarter. The last thing that I want to check on is the balance sheet. And before going in, I do expect that the tangible book value per share has decreased. This is because the recent share repurchases have been happening at levels higher than the tangible book value per share was last month. And this is in addition to the unrealized net losses on financial assets, which on its own outweighs the free cash flow that was generated by the business within the quarter. And taking a look at it now, it does look like this month the tangible book value per share has decreased by about 5 cents. So, not a huge change, and ultimately not something that I'm concerned about, since I still think that the net asset value will be materially higher by the time the intangible assets from the Bayat Scana and Exelon acquisitions are fully amortized. Next, I want to quickly take a look at the cash position in comparison to the total debt. And you can see here that both the cash and debt levels have risen, and this makes a fair amount of sense considering that Knight will have to pay a chunk of money upfront for the Rigel acquisition, and possibly also the Helsinn deal, sometime shortly after these balances here were recorded. Taking a look at the intangible assets, things are still coming down smoothly, though next quarter it is possible that we will see a jump from the two acquisitions that should be accounted for in Q2. And last thing I want to do is check on the diluted shares outstanding just to see how the total share count is looking after this month's repurchases. And you can see here pretty clearly that about 3 million more shares have been canceled within the quarter, increasing my ownership of the company by about 2.45%, which is what I like to see. Knight Therapeutics also released their updated investor presentation in the month, but I didn't find anything worth talking about that went beyond what was outlined in the quarterly report and conference call. So with that, I'm going to go ahead and get into my breakdown of the portfolio's performance and holdings. Starting with Morguard, last month I bought 4 shares of the REIT for $17.99 per share, and these shares declined by 1.45% to $17.73, not accounting for the dividend that was paid. Including the dividend of 5.83 cents per share, this slightly improved Morguard's return for the month to a negative 1.12% as of the market close on Thursday, June the 3rd, 2022. Next, I bought 1 share of Knight Therapeutics for $5.33, and at the end of the month, the share had increased in price by 1.5%, ending the month at $5.41 per share. Lastly was MTY Food Group, who last month I bought roughly 0.44 shares of for an average whole share price of $52.79, and the fractional buy increased in value by about 1.89% before accounting for the dividend. Accounting for the dividend bumped MTY's return for the month of May to 2.52%. So, as of June 3rd, the invested capital for the previous month has increased in value by 0.57% when accounting for the dividends paid, leaving the portfolio with a total of $483.62 on invested capital of $500 and reinvested dividends of $1.40. Now, in previous months, I had not been accounting for dividends in my total monthly return, nor had I been accounting for dividends when comparing specifically my monthly returns to the benchmarked index's monthly returns, though I had been accounting for dividends in the total returns when comparing to the indexes. For some reason, despite not counting my own portfolio's monthly dividends when comparing against the index fund's performances, I was including their dividends, which was creating a slightly inaccurate portrayal of the monthly performance comparisons. Now, it is a bit too late to go back and correct my past videos, but going forwards, I will be using the proper returns, which include my dividends. I'd also like to clarify that this did not impact the cumulative return when comparing my portfolio against the benchmarks, since I was accounting for all dividends in the cumulative returns. This only impacted the appearance of my monthly returns. Overall, this was a pretty average month for the portfolio, with the dividend saving us from a slight decline. So let's check out the 4 ETF benchmarks to see how they performed throughout the month of May. And this month I managed not to come in last place. The S&P 500 index, VFV, was the worst performing and the only portfolio that failed to have a positive return in the month, underperforming my portfolio by 1.55%. The Canadian Large Cap ETF with the ticker symbol VCE was next, and it outperformed my portfolio by 0.65%. The second best ETF was the Global Value ETF with the ticker VVL, and it outperformed me by 0.68%. And finally, the best performer during the month of May was the Canadian All Cap ETF, ticker symbol VCN, and it outperformed my portfolio by 0.91%. And none of these funds paid a dividend over the course of the month. Since inception, which has now been 5 full months, if I had invested $100 per month into each of the indexes as well as my own portfolio, the results would be as follows. The worst performer would have been the S&P 500 portfolio, which would be worth $471.16, representing a 5.77% loss. Next would be my monthly portfolio, which is currently worth $483.62, representing a 3.28% loss. In third place, once again, is the Global Value Index, which would be worth $497.43, which is a loss of 0.51%. Next is the Canadian All Cap portfolio, which would be worth $498.18, representing a 0.36% loss. And the top performing benchmark was the Canadian large cap ETF, which would be worth $498.68, representing a loss of 0.26%. So after the month of May, every portfolio remained in the same position. My portfolio is still ahead of the S&P 500 by about 2.58%, but I'm trailing the rest of the benchmarks by a range of 2.66 to 3.11%. At this point, I feel like I've already been saying every time that everything this early on is pretty much luck-based, since the amount of time that has passed since the start of the portfolio has been very short. Now, I've also decided to track my portfolio and the benchmarks against my goal return of 12% per year, and here's what that currently looks like. Now, everything is kind of cramped in tightly here because of the large size of the monthly contributions relative to the size of the portfolio, but it does show that my portfolio is still 5.28% off from where I would need to be in order to hit my annual goal as of now. I also made another graph to make the profits and losses look more clearly visible. And this was in large part thanks to my girlfriend who said I should correct for the monthly contributions to make things look better. So you have her to thank for the more aesthetically pleasing chart that better highlights the gains and losses net of contributions within the portfolio. And yes, I really was just going to use the first chart, which in retrospect would have been much worse. Anyway, this chart makes it much clearer to see where we need to be at in terms of dollar gains relative to the overall goal. And I'm currently lagging my goal by about $26.94. That said, in month 3, the portfolio had more gains than even the current goal level is at the end of month 5. So I don't have any real doubt that I'll be able to get back on track to achieve the 12% returns, even if it does take a little while. See, the tracked goal will move smoothly in line with the 12% annualized return, but I've been investing long enough to expect that reality is always a little bit more variable, with periods of time where I'll be overperforming and other periods of time where I'll be underperforming. The key is not to get emotionally attached to the performance of the portfolio either way. Instead, I'm focused on what I can do to improve myself as an investor. Back in high school, I had a biology teacher who really liked to use the phrase form follows function. And that popped into my head because not only is it applicable to a lot of things in life, but it also seems especially sensible in this case, in that the focus should be on personal growth and self-improvement as an investor, and letting your returns follow from the application of what you learned from the strategies that have been proven successful over long periods of time. It's usually when people start jumping from one new investing fad to another that their results start to become equally erratic and, over long periods of time, predictably poor. And this is almost certainly because of the form of their results following the way that they function as an investor. Or, to paraphrase Charlie Munger, if you really want something, you have to put in the work to become the sort of person who deserves it. And with that, let's move on to how I plan to invest this month's $100 of contribution and the $1.08 in dividends. And over the course of the last month, I sifted through several different securities that all looked very reasonably priced. I took a good long look at the vehicle parts manufacturer Linamar, ticker symbol LNR on the TSX, and it was looking very cheap in the upper $40 per share range. But it's since jumped more than 15% from where I started looking at it. And Linamar is probably still cheap, but I'm not really confident enough in my research to pull the trigger on it at this price. I also thought a bit about Home Capital Group, ticker symbol HCG on the TSX, which is currently trading for a 17% discount to net asset value. But with raising interest rates, chances are likely that more loans will be defaulted on, which would impair the value of Home Capital's asset portfolio. So HCG was a bit too tough for me right now. Manulife Financial, ticker symbol MFC, was another stock that I strongly considered after watching it slide about 20% on weak earnings. Manulife is a banking, insurance, and global asset management company that I believe has a good future outlook because of its strong geographic footprint throughout Asian countries that are expected to have rapid economic growth over the coming decades. That said, I have a limited amount of money to invest each month, so choosing to invest in Manulife would mean choosing not to invest in MTY or Knight Therapeutics. And I can't say that I'm confident that Manulife's future returns will outpace either Knight or MTY's at current levels. I can, however, say that I believe much more strongly in the quality of leadership at MTY and Knight. See, MTY runs an incredibly lean and efficient management team and board of directors comprised of 7 total members. Meanwhile, Knight Therapeutics is outspoken about ensuring that clunky and costly management systems are hastily replaced upon completion of acquisitions. Now, I don't say any of this to slight the team at Manulife, but when I see a large bureaucratic corporate structure, I can't help but to think that the company is paying a large premium to work slower and less efficiently than they could be. That said, the most serious consideration that I made was on a company that trades for more money than my monthly contribution plus the dividends that I'm currently receiving. So I'd have to sell some shares of Knight Therapeutics in order to buy a single share, since the company does not have fractional shares available with Wealthsimple at the moment. Now, this is a company that I really like and believe will perform incredibly well in the future, but ultimately I decided against purchasing a single share of it because buying this one share would mean foregoing the opportunity to invest in Morguard at what I believe is an exceptional price. But in future months, if things line up right, don't be surprised if you see me making a big move to include a new addition to the portfolio. For this month though, I'm going to go ahead and allocate the same way that I did last month. 4 shares of Morguard, 1 share of Knight Therapeutics, and the rest is going into MTY Food Group. So let's hop forward to the clip of me buying shares. Alright, so I'm here in the account on Friday, June the 3rd, and we have $101.08 to invest. So let's go ahead and start with Morguard, which appears to be trading at about $17.54. We're probably going to get it for $17.55. We're going to do 4 of those. And next, continue, confirm the order. Okay. Just make sure that goes through. All right, and next we're going to buy Knight Therapeutics, and we're going to buy 1 share for market price, should be about $5.41. Let's buy that. And last but not least, we have MTY Food Group, which we are going to buy a fraction of a share with, the $25.47 that we have left. So $25.47 looks right, and we should get about almost half a share. But we won't know until a little bit later on, so I'm going to confirm that. The order has been submitted. We have no money left to spend. And I will get back to you when this comes through. Okay, and I'm back a little bit later on, and I've just received confirmation from Wealthsimple that the MTY order was filled at 3:01 p.m. and I received 0.4747 shares for $25.47, giving me an average price per whole share of $53.65. In addition to that, my 1 share of Knight Therapeutics was purchased for $5.41, and my 4 shares of Morguard were purchased for $17.55 each. So I'll put that into the spreadsheet and see you soon. All right, taking a look at the portfolio after investing this month's allotment and after market close on Friday, June 3rd, the portfolio now holds 24 shares of Morguard worth $420.96, making up 72.68% of the portfolio. The second largest holding is now MTY Food Group, of which I have 1.6462 shares worth $88.19, comprising 15.23% of the portfolio. And the smallest position in the monthly portfolio is Knight Therapeutics, which now makes up 12.1% thanks to the 13 shares that are worth a total of $70.07. And as per usual, there is no cash left over in the portfolio. Moving on to the distributions, this month the portfolio received a distribution from 16 shares of Morguard, bringing in 93 cents. And I also received a dividend from MTY Food Group on 0.7 shares, providing an additional 15 cents, bringing the total amount received during the month of May to $1.08, which is 1 cent shy of what was expected at the start of the month. So what happened to the missing penny? Well, it turns out that this was just a rounding error. See, Google Sheets rounds up on fractions of a cent because combined, MTY's dividend and Morguard's dividend equaled slightly over $1.08.6. This led Google to round the number up to $1.09. The thing is, Morguard owed me 93.3 cents, which would be rounded down to 93 cents. and MTY owed me 15.3 cents, which was also rounded down to 15 cents. This left me with $1.08 as opposed to the expected $1.09. This obviously isn't too big of a deal, and I'd expect stuff like this will happen again in the future, but I figured I'd give an explanation for it anyways. As for ex-dividends, Morguard is the only security to pay a distribution in June, and the portfolio held 20 shares on the date of qualification, which should bring in $1.17 in dividends. This means that even though we don't have that MTY dividend coming in this month, we will still have a record month, hopefully in June. And this $1.17 expected should push the cumulative dividends received in the portfolio to $3.65. As for the yield on cost, which measures how much will be earned in dividends over a 1-year period relative to the price paid, assuming nothing changes, I can expect to receive $16.79 per year from my 24 shares of Morguard. This gives my MRG holding a yield on cost of 3.77%. On my 1.646 shares of MTY Food Group, I can now expect to receive $1.38 per year. And when factoring in the price that I paid for the shares, my yield on cost for MTY is 1.58%. When combining MTY's dividend with Morguard's, I get a total expected annual return from distributions of $18.17. This leaves the monthly portfolio with a total yield on cost of 3.02%. Which of course assumes no changes to the current dividend payments or the number of shares held. I've also decided to add a yield on contribution metric, which only factors in money that I've directly put into the account, and unlike the book cost, does not include reinvested dividends. And my total yield on contribution for the monthly portfolio is 3.63%. And that's about it for this one. This month, I made a lot of changes in selecting different measurements of performance within the portfolio, but I could be missing or not focusing on something that you might consider important or worthwhile, and if that's the case, let me know. Just leave a comment in the comment section. And with that, I encourage you not to use the information presented in this video as financial advice. Instead, use what you learn here as a starting point to do more research into companies that interest you. None of my videos have enough information necessary to make good investment decisions on individual securities. These videos are made only to provide inspiration and insight into my personal investment decisions. And I'm not a financial advisor. I'm just a Canadian who likes to invest and share my opinions with others. And in doing so, I hope that I was able to provide you with some value. And if I did, then please consider sharing this with someone else who might also benefit from it. Thank you for watching all the way to the end, and enjoy the rest of your day.